Hi students. Today we are going to discuss about financial system. So financial system of our country is very important. Everyone should have knowledge about financial system, how it functions, what are the important components of our Indian financial system, then what is meant by financial institutions, what are the functions of financial intermediaries, how the financial markets are classified, how these services are important for economic development of the country. These are the important things we are going to discuss in our class. Before going to in depth of our Indian financial system, you people should have a basic knowledge about what is meant by financial system. Financial system is consisting of variety of institutions, markets, and the instruments which are related in a systematic manner and provide the principal means by which savings are transformed into instruments. So here we are talking about variety of institutions. It includes insurance company, bankings, mutual fund, all different kind of financial institutions are included in our financial system. And financial instruments, what is meant that? Check, money market instruments, treasury bills, everything is included in the financial instruments. So this is very important for the economic development of the country. So the Indian financial system is one of the most important aspects of economic development of our country. This system helps to manage the flow of funds between the people of the country, that is, who are having a money and those who needs money. So the mapping of people who needs money and the supplier of money is happened in the Indian financial system. That funds between the people of the country and the one who may invest it wisely for the betterment of both the parties are happening in the financial system. So financial system is a network of financial institutions such as insurance companies, stock exchanges, and investment banks that work together to exchange and transfer capital from one place to another. So through financial system, investors receive capital to fund projects and receive better return on their investment. So simple thing, the simple terminology I wanted to explain what is financial system. One side of the coin, people are having money. The other side of the coin, people who needs money. How these people are matched or mapped with the help of the financial system, these people are matched. Next important thing is here, Indian financial system, how it functions. I explained this. The features of Indian financial are very important, that helps for the economic development. Before going in depth in the features of Indian financial system, let me explain that what are the different components of financial system. This diagram helps you to understand briefly about what are the different people are functioning here, what are the different aspects included in the financial system. So let me explain here first 4 things here in red color. Financial system include financial institutions, financial markets, financial assets or instruments, financial services. So these are the 4 important components operating in financial system. Okay, let me explain now financial institutions. Financial institutions include banking and non-banking. So these are subject to rules and regulation of RBI and other governing body. So here banking, when you take a, let me finish the financial institution first. Here banking institution includes commercial banks, cooperative banks, regional rural banks, and foreign banks. So all these 1, 2, 3, 4, all these 4 categories are coming under the group of banking institutions. When you take up the commercial bank, it may also include private banks and public bank. Example, public bank, State Bank of India is called as public bank. HDFC is called as a private bank. Okay, I think it's clear. Now, we'll move on to non-banking institution. So, example, Sundaram Financial Institution, these are comes under the non-banking financial institution. Now, so financial institution include banking and non-banking. Banking include, there are different types of banks, commercial banks, cooperative banks, regional rural banks, foreign banks. Okay, now we'll move on to financial markets. Financial markets are classified into 2 categories. One is unorganized market, another one is the organized market. Now, again, the organized markets are divided into 2 categories, broad categories, capital market, money market. So we all know that capital market is nothing but BSE, NSE, all are comes under the secondary market. Capital market is again divided into secondary market and primary market. Everyone would have heard about IPO, initial public offering. The first time the company before listing the company raising the fund, that will be listed in the primary market. It is raised in the primary market and again purchase and sale happen in the secondary market. Secondary market, that is BSE, NSE, all this thing. We all know that these are the 2 important markets in capital market. So here unorganized, organized. Organized is divided into capital market, money market. Money market is very short-term market. It is noted as very short-term market. So organized market is divided into capital market, money market. Then again capital market is divided into secondary market, primary market. Now, third category is financial assets and instruments. What is it? So here no classification is given. Treasury bill, bill of exchange, checks, everything comes under the financial assets and instruments. Next thing is financial services. Financial services means, example, merchant banking services for raising the funds, starting the business, all kind of services are provided. Exclusively some of the financial institution functioning for providing this kind of services. Here, financial services are classified into 2 categories. One is a fund-based service, another is a fee-based services. So under fund-based service, leasing, hire purchase, consumer credit, bill discounting, factoring, insurance, etc. will come under these categories. Next thing is a fee-based service. Fee-based service includes issue management, merchant banking, credit rating. Some of the companies, when they are issuing the shares, they will be credit rated, debt restructuring, stock brokering, all these things. So now I conclude this diagram. Financial system consists of financial institutions, financial markets, financial assets and instruments, financial services. So I think is it clear? Next we'll move on to features of an Indian financial system. What are the features of Indian financial system? Actually, It helps for the economic development of the country as it encourages both savings and investment. It also helps in mobilization and allocating one's savings. So I already told you, it's just mapping the people who have money needs and the people who have surplus capital. Shortage of money is, that is surplus capital is matched with this surplus money is matched with the people who are shortage of money, who needs money. It facilitates the expansion of financial institutions and market. It also plays a key role in capital formation. It also helps forms a link between investor and saving. It is also concerned with the provision of funds. So these are the features of financial system. Next, we'll see the significance of or importance of financial system. So first one is everything comes around rooting around economic development. Financial systems are important since they encourage people to save by offering attractive interest rate. These savings are then channelized by lending to various business concerns which are involved in production and distribution. So take example in bank, the investors are encouraged to open a bank, customers are encouraged to open a bank account, that is fixed deposit account. When they are having everyone may have saving account, but they may be encouraged to open a fixed deposit. So fixed deposit, what the bank will do, they will offer very less percentage of interest, nearly 4.5% to 6% it offers. So the money is collected from the public, the people who are having a surplus or savings, their savings are channelized and routed to the fixed deposit account. So then from the fixed deposit account, that is the people who needs money, the bank will provide loan at a higher than the rate at which it got money from the public, that is the customer. So the difference is the profit for the banks. So that's I'm telling. It is mapping people who have surplus money with people who are having less amount of money or who needs of money. So that is exactly happening in the financial system. It also helps in monitor corporate performance, how the company is performing, what is the value of its debentures, whether the company has a reputed or we can believe and invest in the company. That is assessed with the help of the credit rating done by the various financial institutions. It links savers and investors. This process is known as capital formation. I already discussed with you how the mapping of surplus and people who needs money is happening. It also helps in lowering the transaction cost, increase return, which will motivate people to save more. Transaction cost must be reduced. Then only people started borrowing money. It also helps the government in deciding monetary policy. It refers what is meant that, see, when there is a high rate of inflation, what the government will do through monetary policy, it will suck the excess surplus of money available in the market, that is flow of money, that will be sucked. How one of the method is, it may offer higher interest rate, so people will deposit in the bank. Suppose they want to inject money into the market, what they will do, they will reduce the lending rate. When they reduce the lending rate, automatically investors like to borrow. So this is the kind of monetary policy RBI is following to maintain the inflation under control. Now, so before moving on to the functions of the financial system, we should have an idea about financial intermediaries. So these are who are, there are so many intermediaries are in between savers, that is depositor, and borrowers. So here you see the two people are the left, extreme left and extreme right. So in between these two people, so many things are happening with this diagram we can understand. So before I'm going in depth about how this work out, let me explain about what is meant by financial intermediaries. Financial intermediaries is an institution or a person that acts as a link between two parties of a financial transaction. Here, who are the two parties? Savers and borrowers. The parties could be a bank, mutual fund, etc., where typically one party is the lender and the other party is the borrower. So here, who is the lender? Here, the person who is having a surplus money. This person is called as a lender. The other extreme, the person who needs money, he is called as a borrower. There are various types of financial intermediaries such as banks, credit unions, insurance companies, mutual fund companies, stock exchanges, building societies, etc. So these are the various financial intermediaries. They are helping to connect savers, that is deposit lender and borrower. So there are different methods in which they are connecting. Okay, now what are the various benefits attained by the investor through intermediaries? These financial intermediaries. These financial intermediaries are helping the society as well as the borrowers and savers. So what are the benefits of financial intermediaries? We'll see. Here, what are the various benefits attained by the investors through financial intermediaries are? First one, see, safe investment, greater liquidity, financial specialist, economics of scale, convenience, risk spreading. So these are the main advantages. What do you mean by greater liquidity? Greater liquidity, that is by by growing economics of scale, costs are kept lower for startup business or borrowers. Operational costs, paperwork, and credit analysis are all handled at scale. So that helps to create a liquidity. Next important aspect is the convenience. So convenience, what is meant by convenience? Funds are spread across the diverse range of investment type. A diversified portfolios spread out the risk of capital loss. So that is one of the important aspect. Then everybody wants to save investment. Their investment must be safe. At the same time, they want to earn higher rate of interest also. Intermediaries also reduce the risk of fraudulent behavior as they have additional security measures in place. So that is one of the thing everybody wants to keep. Their investment must be safe. Next, financial specialist. What do you mean by financial specialist? Rather than spending time on research, investors are connected with borrowers via third party who does all the work. That is the third party who are connecting these people. That is called as a financial analyst, financial or specialist. Sometimes financial consultant. They are connecting these two people in different ways. Next, the greater liquidity. Financial intermediaries have the assets in place to allow for greater asset liquidity. Borrowers can withdraw funds as when they needed. So these are the one of the important things, advantages of financial intermediaries. So now you have seen who are the financial intermediaries here. Financial repayment of loans, interest repayment, interest payment, low rate. So everything is happening. Here the various benefits we have discussed. Now we'll move on to types of financial intermediaries. Types of financial intermediaries are, these are the people also called as a financial intermediaries. Banks, credit unions, non-banking finance companies, stock exchanges, collective investment schemes, mutual fund companies, insurance companies, financial advisors or brokers, investment bankers, escrow companies, pension funds, building society. These people are all called as the types of financial intermediaries. So there are different types of financial intermediaries formed to serve different aims and objectives of the customers or members, that is lenders, borrowers. So that is clearly explained how these people are helping to connect the saver and the borrower. So with the help of these people, we can connect all this say, that is the people who have money and people who needs money. Next important thing is we see that is benefits of attained by the investor through financial. We have discussed greater liquidity, convenience, safe investment, financial specialist, greater liquidity. These aspects we have discussed. Next thing is the important thing is the constituents of, that is the components of financial system that I have explained in the first slide. These are the components of financial here. Now we'll see this in detail. Financial system include financial institution, financial market, capital market. Capital market includes primary market, secondary market. So these two market are comes under capital market. Then secondary market, financial services, financial instruments. So this is explained here. Here see financial market are divided, classified into different categories based on nature of claim, maturity of the claim, timing of delivery, organizational structure. So based on nature of claim, debt market, equity market, these are the two things comes under nature of claim. Maturity of claim, that is a money market deals with short-term funds. Capital market deals with the long-term funds. That is, capital market is divided into primary market and secondary market. Next, the timing of delivery. Timing of the delivery comes under the cash market and future market. Future market is also, you can say, commodity market, derivatives, everything we can discuss under here. Then organizational structure, based on organizational structure, exchange traded market, over the counter market. These are the main classification of financial market. So now we'll see the types of financial institution. Here types of financial institutions are commercial banks, investment banks, brokerage firms, insurance company, mortgage investment. So each thing serve for different purposes, depends upon the nature of the transaction that happen. We already discussed commercial banks. It may have public bank, that is public as well as private bank. Public bank example I told you, that is the State Bank of India is called as a public bank. HDFC is called as a private bank. Next, the investment bank. What is investment bank? So investment bank main function is actually helping to arrange the funds for the institution, subscribing funds. This kind of activities are done by the investment bank. So these bank specializes services like initial public. These banks are specializes in offering services like initial public offerings, other equity offerings, proving for mergers and acquisitions, institutional client brokerage services, underwriting debts. So all kind of activities are done by this investment bank. As a result, constant mediation between investor or public and the companies issuing security. So it is connecting between the company and the people who wants to invest in the companies. That is the one thing important aspect we have discussed. Next thing is the we'll see the important aspect difference between capital market and money market. Here, one of the important thing is the money maturity of client. It's divided into money market, capital market. Capital market is divided into primary market and secondary market. That we will see capital market, money market. What is it? Simple thing. Money market is very short-term market. Capital is a long term. It is a market where lending and borrowing takes place for a medium and long term. But as far as money market is concerned, it is a market where lending and borrowing take place for a short term up to 1 year. They deal in equity, shares, debentures, bonds, and preference shares. But here they deal in treasury bills, commercial bills, deposits, etc. All these things are short term in nature. Even 24 hours transaction is also happens in the money market. Capital markets are formal, money market is informal. Due to its less liquid nature and long-term maturity, the risk is comparatively high in case of when the period is lengthy, automatically the risk also in proportion to the period, it also increase high risk, high return, low risk, low return that is applicable. Due to more liquid nature and maturity is less than a year, the risk involved is less when compared to the capital market. The capital market fulfills the long-term credit needs of the business, but the money market fulfills short-term credit needs of the business. Then another important thing is here it stabilizes the economy due to long-term savings. It increases the liquidity of funds in the market. But here capital market the returns are high because of higher duration. The returns are usually low. Then now we'll see that what are the roles of financial services. It helps business to grow, promotes entrepreneurship, it encourages the new startups, promotes free and easy trade, ensures availability of money in the economy, then ensures easy availability of loans and capital, promotes infrastructure and development. So these are the main important role of financial services. Then we see one more important thing, classification of financial market. Here we have seen the financial market. The first slide we have seen what are the different types of financial market. So that only we have discussed now the difference between the capital market and money market. Some of the few terms you should understand the capital money market and the capital market. That is the type of financial markets over-the-counter market. Over-the-counter market, they manage public stock exchange, which is not listed the NASDAQ, American Stock Exchange, and New York Stock Exchange. So these are the important things we have discussed in the class. Here, I want to just brief it. What are the things we have discussed in the class? First thing I discussed, what is meant by financial system. That's very important. It includes financial institutions, insurance, stock exchanges, investment banks, all these things. All these things are included in the financial market. Financial system. Financial system include financial institutions, financial markets, financial assets and instruments, services. Next, the various features of Indian financial system are discussed and the importance, then who are called as a financial intermediaries and how this financial intermediaries works, that is discussed. Then what are the important advantages of financial intermediaries? Then what are the different types of financial intermediaries? Then what are the benefits attained by the investor through these people? How these people, financial intermediary, help the matching or connecting the people who have money and people who need money. Then what are the constitution of financial institution we have discussed. Classification of financial market we have discussed in detail. Types of financial institution. Then what is the difference between capital market, money market we have discussed. How the role of financial services. Thank you, students.